So you want to hear a quick summary here on what happened with
Yeah,
Rivian?
give me a quick summary.
Very simple. So Rivian, basically, the CEO came out, I think, in the last conference call, I think Q3, right? And he goes, "We're gonna shut the factory down for the last 2 weeks, and Amazon's not going to take EDV deliveries in the last 2 weeks of the year, in the last month of the year, because it's the busiest season. They're not going to onboard new vehicles busiest time."
Yeah.
So what happens is Rivian comes out, and the street is estimating that Rivian's going to going to process more deliveries than obviously Rivian guided for. Rivian beat their 2023 delivery expectations, right? Or they beat their number. Rivian guided for numbers. Rivian beat those numbers, their own guided numbers in 2023, but they missed on the fourth quarter street estimates. I would assume the street knew that Rivian was going to close the factory down. There would be a delay there, but I guess they took it out. It got blown out, and that was here. That was this move here. Then, I mean, Tesla's been under fire, right? Tesla's been under fire. Like, look at this shit since December 28th, right?
Yeah.
And if you take a look at Rivian and you you overlay Tesla, you get a pretty good idea of what's going on here. Like, let's see if we can make this like just some obtuse color we can see. But you can see like they trade pretty closely, believe it or not, like up and up, right?
Hmm.
Down to up.
That's
Like
kind of
you're
interesting
basically
how they really diverged in November, December, and then Rivian caught up to it.
yeah, and obviously, so there's another factor going on here, right? The shipping conflict in the Middle East. Um, that Tesla basically came out and said that and Volvo came out and said that they're halting, um, they're slowing down the production slash halting the production in Europe at the moment, right? And Tesla fell on that news because, again, that's not good. Tesla's all about delivery. That means that they're going to have to re-guide their deliveries and re-guide their cars produced, etc. Right? Tesla was down 3.67%. And my theory on this is Rivian's going to trade in this bucket of EV stocks. Um, Rivian's going to trade in this EV bucket of, like, if Tesla's down and anything bad comes out about EV sector, they're gonna slam the bid, basically short, right, on these other EV stocks, even though these other EV stocks might not be shit, right? For example, Rivian has very little to do with anything in Europe,
Hmm.
right? Rivian's only delivering certain vans to certain Amazon vans, I believe, overseas. That I know for a fact they don't have any overseas retail car product or
Wait,
commercial
so you're saying like
consumer
if
base.
there's a reason to short EV companies, you may as well go with the smaller ones because you have the downside in your favor.
Right. So take a look at
Like,
Lucid,
why
right?
would you
Look at
short
look at
Tesla
this.
when you can short one of these?
Well, no, so what I'm saying about Rivian is if something bad's happening in the EV sector, how I think there has to be, because I've seen the stock move in certain ways already, that I think there's some quant funds that will jump on the bid or the ask directionally if there's a catalyst on Tesla, right? Because like if something good happens to Tesla, right, Tesla starts ripping. What they do is, you saw Rivian, right? Rivian starts accelerating, same type of thing. Rivian's down 3.89% today. Rivian's not really in many ETFs. Okay, it's a $20 billion, $17 billion company. It's small, right? And they actually they produced 50,000 cars in 20 over 50,000 cars in 2023, right? And then take something like Lucid, right? Rivian's in the same basket of Lucid as Lucid, but Rivian's a far superior company. And look at Lucid, right? Lucid just really shit the bed. Like we're talking, Lucid's down 22% in a week.
Hmm.
It's down 27% year to date. Rivian, on the other hand, right,
Their
is down
their delivery numbers are way smaller too, aren't they?
way smaller. So I think that's like something you have to pay attention to. If you're I like this. I like Rivian. I think the company, they're a company that comes off. And this would be like a more of a fundamental play, right? Like we can focus on the trends or whatnot, but at the end of the day, like if we're talking multi-year horizon, I don't think you can use a short-term, medium-term trend to ultimately gauge what's going on in the, like how to hold your investment. Now, can you size down and up into those trends? Obviously, but I think if you're talking a longer term position here, and I'm talking at least 2 to 3 years, Rivian comes off as a company that's under promising and over delivering, the complete opposite of Tesla. And that can either hurt the company or help the company, right? So in Tesla's case, Elon was so overly optimistic all the time that everyone priced in, this is going to be great, this is going to be great, this is going to be great. And then we had the letdowns, right? The stock sliding 50% multiple times. Everyone's like, oh my God, the short's going crazy, the stock's going to go out of business, our company's going to go out of business, long so on and so forth. No, Tesla didn't go out of business. But I think that some of that hype is missing from Rivian, and it's a good thing too, even though it doesn't, it means you're gonna have like a slower ascent, like ascent to the high, pretty much back to where it IPO'd at 100. But it also means more stability, right? Because the CEO is not coming out here and over promising things like, the Cybertruck was something that was released, was expected to be released years ago. Now it's only hitting the market this year, right? In the last couple of months.
Yeah,
And
but
that
that's
type
the
of
game,
delay,
right? That's the game, and Rivian's not playing that game. They don't want to. They don't have that hype factor that Tesla has.
they don't have that hype factor that Tesla has, is true, but they also don't, I don't think, like, for example, you're never going to catch the Rivian CEO in, I don't think, right? Under pressure from the SEC for, saying funding secured on Twitter.
Yeah,
You're never gonna get that, right? And I think that that offsets some of that volatility. Now, obviously, it's still a volatile stock. We're talking about just in a couple of weeks, the stock moved up, 60%, and then shortly thereafter, it's down 26%. So there's definitely volatility in the stock, but I think that the CFO has made some interesting notes about going gross margin positive in 2024. If they can do that, I think the company will be on pace to be a real. I'm not talking about like these, like Polestar or anything, like an actual household Tesla competitor that is fundamentally um, an electric car company. I'm not talking about, like, obviously no Volvo, no BMW. Like, I'm talking, um, just a straight car company. And there's a lot of things that the company can expand to do. It can expand into, and it's, expanding insurance and other areas
yeah.
of
They
business.
they started doing the leasing program.
Yeah, that's great too. And their cars don't yet qualify for the full $7,500 tax discount, which Teslas do at the moment. And that has to do with some of their battery sourcing, I believe, which I think Rivian has made note that they're working on getting in compliance there, so they can give their customers that full $7,500 discount. But I
Yeah.
think
The
that's
in
an
my opinion, the way to invest in this isn't really by using the trends because this doesn't have an established trend. Like I wouldn't use DDAP on Rivian until they get an established trend, like Tesla eventually at some point did
yeah, like, I
on
think
the way up. But
what you're saying is like this. Like, we're here in Rivian stage right now.
yeah, it's like you can't really use the trends just yet. Right now, it's kind of the at least for me, I'm invested in Rivian, and my investment thesis is as long as the core of the company doesn't change. If they start changing around who they really are and like their main product is changing in a way that I don't like, that's my exit. The what the actual stock price does is not my exit. Like I put in enough money that I'm comfortable fully losing, and that's kind of something you have to do with smaller companies like this. But I'm not going to like sell out on a bearish trend flip or anything like
R-
that.
Right. And I guess the best way to put that is like, it's a value play, and I don't mean like a Warren Buffett like value stock. It's something that in the stock market, as Warren Buffett has said, right? Short term is short term price actions a voting machine, long term price actions a scale machine, a scale, right? It's a weighting machine. So short term, the stock's going to move, but if you can isolate the value that you think you're going to see, you have to let that weighting machine play out. You can't just buy it and then like sell it up here, try and buy it down here. If you believe in the business model, you buy it and you wait. And this is completely different from our other scope of quantitative algorithmic trend following and stuff like that, right? Trend following basically short-term investing and swing. And it's longer than swinging, but it's less than investing. It's that middle ground, right? This is straight up investing. Like you're buying Rivian at a $17 billion valuation. They're doing they did in 2022 1.6 billion in sales, 1.66 billion in 2022. Now every quarter they're probably going to average a billion a quarter into 2024. So they're already going to pretty much 3x what they did in 2022 altogether every quarter in 2024. So the company's obviously growing. There's upside here. The stock did IPO in a different environment. We're talking different interest rate environment, different liquidity environment, and $100 a share went up to 200. Can we see the IPO? We believe, or at least I believe, we will see the IPO price again at some point on the stock. So that's the investment thesis. Now, unfortunately, the company's going to have to drastically change to get back to where it IPO'd at. When the company IPO'd, they hadn't done any revenue. Their first quarter revenue was $54 million. They're doing last 3 quarters $1 billion every quarter. So obviously something has changed with the company that's grown a lot since then. And I think it's going to have to continue to grow at a current or above current pace to really get us back to that 100 mark and hopefully higher from there. So that's the investment thesis on Rivian. We're long and we're strong right now, and we're not going to falter at some short-term price action unless, again, like you said, something with the core business changes. You know, if, for example, we get a new CEO, we got a new CFO, we get a new wave of equity offerings or something like that. There are some convertible notes out there on the stock, but it's not that much of an issue at the moment. Or we start to see this real issue of having to raise excessive amounts of cash, right? Which would be those equity offerings. Would be the purpose of the equity offering. So unless we start seeing some of those, like, you know, typical backdoor shenanigans going down, I think we can ride this one higher. So that's
Yeah, I
what
mean,
we're going
in
to do.
terms of their financials, like they're pretty solid. They're putting a lot of money into R&D, which is exactly what Tesla did at the start. You kind of have to do that at the start. You need to really build
Right.
your product.
Yeah, and I mean, on a numbers basis, right? Like if we take a look at what they're doing on just on a book value per share, right? It's $11 a share. So like we're what, 60% from book or something like that, 70% from book. So
Well, for
if book value's
comparison,
here,
show what Tesla is.
I mean, Tesla's going to trade at a premium because, again, they're profitable, right? Rivian's not profitable yet. Rivian's
Mm.
losing 30K per vehicle, but let's take a look at Tesla. Tesla's book value is $16 a share,
Oh wow.
and the thing's trading at 218.
Yeah, it's
And
quite
Tesla's
quite a
going to,
big difference.
yeah, but like, so for example, Tesla's also doing, right, every quarter they're doing 20 billion in revenue. They've been averaging like a 10% profit margin for the last couple
Yeah,
of
there's a
quarters
big
combined.
difference between actually pulling in a profit.
Right. And remember, for the longest time, Tesla wasn't making a dollar. It was Tesla for the longest time was making more money for the company selling stock, basically issuing equity on the open market than they were selling cars.
Yeah.
And Elon was top G for doing that. Like, think about it. Like, your stock's going up like insanely, and you need to bring in capital. You're going to raise money on. I would issue stock too. Why not? You're adding cash to the bottom line. You can use it to leverage your business. Like, that's something that Rivian unfortunately doesn't have, at least not at the moment. But they just started up production in the last 2 years, so we got to see how this rolls out. I do think that um, if they can get the gross margin positive in 2024, and we can see their cheaper line of vehicles released and received well by the community, I think that the stock obviously goes higher. They were rated like out of like 5 car magazines, they were in the top 2 or 3 of all car magazines for electric pickup trucks in 2023. So it's definitely a quality product. Um, and I went and I sat in one just to see what was going on. Obviously, I like to look at things before I put money into them, just get a feel. There's certain things you can't, right? Certain companies you have to buy and just understand that you will never get to see them. Like, for example, if you buy Raytheon, I don't think you're going to get into reaching distance of a Predator missile, right? So you just kind of have to understand what's going on. But if you can, always look at the product, and if the product seems sturdy, seems good, care and quality were put into it, and you understand the business model, then by all means you invest accordingly. So that's what we did with Rivian. But
But yeah, let's get into the quant deck.
Yeah, let's get
So
into
we're
that. So,
super hyped about this quant deck that we pretty much worked through all of Christmas and New Year's. This was our Christmas and New Year's vacation, and more, working on this quant deck, rebuilding the system, making everything more robust, and we're super excited to share it with everyone. And so this is available to the members. This is going to be replacing the daily report. This refreshes every single day, and let's run through it.
all right. So, obviously, this is as of Friday, the day we're recording this, January 12th, 2024. And it's pretty much like the weather report for those that are familiar. Very simple, straight to the point. We've changed the macro events now. Instead of changing them daily in the report, just for the week, and it highlights the upcoming events. And we've added more regions, so those around the world that are interested in following other events, they can get an overview here.
And
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 then,
actually, we're thinking of, well, we're not thinking. We are already starting to work on it. We are wanting to expand to Eurozone first. Is what we're going to go towards first. We're going to do the UK, Japan. We're going to build the system in each country. So having our growth and inflation metrics and letting us know which regime those countries are in as well, and seeing if there's a correlation between that and the United States regimes, and possibly seeing if there's any more improvements we can make in the system by using these global metrics. But at the very least, we will have a system for each country, each major country, and whether or not that affects the United States system, that doesn't we don't know that yet. That's going to be in the research and development that we'll be putting into it, but we're pretty excited to get into building these for the other countries as well.
right. So going forward here on our dashboard, this is what you would see for each of those regions that already just explained about, already just explained or went over. The each regime, or excuse me, each zone, so this is the United States, is going to have its own inflation index and growth index. These are market radar proprietary indexes. And the strength of each index is going to determine where we are in the regime map. So as you can see here, this is the regime map, and we have the expansion, inflation, stagflation, deflation. Again, this is pretty similar to what our members are already used to, right? We're the Ford regime system. We've been using this for our entire time, or the entire time at Market Radar. So this is also a common system used on Wall Street, right? In terms of monitoring the economic regimes. Now you can see a trailing 1 year or 12-month path of where the regimes have been. And the blue dot in the orange square shows you where we are right now with the black text. So obviously we are in the middle between expansion and inflation.
Which
So
really
we're
explains why equities have been doing what they've been doing over the last few months here.
right. Obviously, we noticed that there were some system improvements moving over to the new system, which ultimately what it did was it yielded a more sensitive and more reactive growth metric. So, for those wondering what the shifts were coming out of the old system to the new system, that's really where a lot of the change happened. And a more dynamic inflation index all combined together, we have a more a higher level and just higher quality map and quantifiable process that we can expand and leverage off of. So that's pretty much what happened there with these system updates. And then obviously up here on the right, you will see the strategy positions, what's going on, what the allocations are to each strategy of the original size, and what the allocation is, what the year-to-date P&L is for that strategy. And above that, you will have the current risk environment and the current regime. Now, some of you guys are probably wondering, well, if we were in expansion, why? What caused the inflation switch if the inflation index is zero? The answer is very simple. The way the regime system works is if we get a print, a print with any confidence in any of these regimes, going to zero will not mean that you're in a no regime status. It will hold the prior regime. So somewhere along the line in the last 2 or 3 months, not most likely, it did happen with stage three. As stage three progressed, we had a small bump into inflation. We had a little bit of a shift here to the right, and a little pop higher on the inflation index this was most likely here, that put us into the inflation regime, but quickly died off. Trend flattened out. We're in neutral. We're at 0% strength. So we're on the verge here of possibly, if this continues, flipping back to expansion again. So keep that in mind when you're looking at this report on a daily basis, that we are teetering now between expansion and inflation. So we are not risk off. Obviously, we'd have to cross the x-axis to breach that territory, which we've been dropping slowly, but we're still holding firm up here in risk on territory overall. So let's move on to the economic summary. This is pretty straightforward. We have this for the United States, and starting next week, or starting as you guys hear this on Tuesday, after this podcast is released, we are going to have the Eurozone in here as well. So what that's going to do is it's going to include, similar to how we have the Fed implied futures curve here and the Treasury curve, you're going to have the ECB implied futures ECB implied rates futures curve, excuse me, and the ECB yield curve. That's going to be all here and replacing these two data points. And then on the left, you're going to have all the Eurozone relevant versions of these data points. So you can pretty much track a high level overview of what's going on from a data perspective. And it's very simple to read. So this is PMI, and the reason these are red and green is because PMI, anything above 50 is positive, we're expanding. Anything below 50 is contracting. So that's why if it's green, it's above 50, it's expanding, and if it's red, it's contracting. Very simple. And then the other data points here just show you when they were released, what the prior value was, and what the 12-month high and 12-month low of each data point was. So you can get an idea of where you are within the range. So for example, we'll just take high yield credit spreads right now, credit default swap spreads, excuse me. And right now we are pretty much at a 12-month/52 week low. As you can see, the 12-month low is Jan 2024, and we are here. This is the value. So high yield credit swaps are printing new 52-week lows, and that is not surprising given the current regime. So that's something that you can kind of put one and two together as you read the report. It'll make sense. Investment grade swaps should be printing 52-week lows. They are very close compared to where they were last month, but they're down there. So I'm assuming if the current regime holds up, these will continue to print both of these will continue to print new 52-week lows.
Yeah, and also something I want to add is that implied overnight Fed rate there. So we also included a 15-day trail, so you can really see, and it adds more context, and you can see how the market is shifting the price, which is very useful right now as we're in stage 3 going into stage 4, or stage 3 going in deeper into stage 3. You can see if the market's starting to price in more cuts. That's a huge sign of deeper stage 3 pricing, which we actually saw last week and over the last couple of weeks as equities were rising. They were pricing in more cuts, and this chart really adds a lot of context in that area.
Right. And then as we scroll down here, you have your historical regime system data. So what this will do is this will tell you the number of historical regimes, then the number of historical regimes, and the percentage of each regime going back throughout history here, going back to the inception of the
I think
regime.
That's a glitch there too.
Yeah, I think that's a glitch here.
That's not part of the report.
That's not part of the report. But long story short, this goes back. The inception of the system is August 13th, 1991, and from there you can see all the historical regimes and the reactions of both SPX and the long bond total return index, both total returns, I should note, in each environment. I also want to actually note here that the trends on the dashboard are total return based outside of VIX. This is spot. And what we'll do is we'll note in here that this is spot. The reason that we want to use total returns is to give an overall view of what's going on for things, especially like utilities and real estate that have an inherent dividend that if you discount will basically offset some of the early price action moves that you need to pay attention to. So we've made everything total return again outside of VIX.
And that's a reminder for those using DDAP. Make sure you always have dividend adjusted turned on your charts. So that'll give you the total return data. You might have some discrepancies from your trends versus what we have on our report here because we get our data straight from the source and it's the index data. So it will differ a little bit from the ETFs that you might be watching. So keep an eye out for that if you
Yeah,
see
I mean
anything.
we're talking when we differ maybe 1 day or something like that. It's not going to be something drastic where you're going to see something be printing an opposite trend for months, and we're talking about maybe 1 day of difference. So don't get too scared if you see something different, but do understand that your DDAP is not broken and the report is not broken. Just understand that these could have the tendency to shift a little sooner than what you might see on DDAP, but it's going to be around the same. It should be for the most part the same. And then let's go to the asset performance by regime. This shows you the expected returns in each regime for each asset. We're going to put little flags here for the actual returns so you can get a better idea of what this is. Unfortunately, Bitcoin just blows everything out of the water, right? Because it's just such a drastic outperformer overall that it kind of skews the data. So we want to just mark it and show you guys what exactly is happening for each asset, so you guys have a better understanding of like what really is outperforming and underperforming on these risk on regimes where Bitcoin is just astronomically higher. Um, and then following, obviously, we have the bread and butter, Aries. This is our main strategy. And there will be additional strategies added to the QuantDeck over time. But what they're basically going to do, or what these strategies library slides aim to do, is number one, on the first slide, simplify the strategy and give you what you need to know. And on the second side, give you the actual background for the strategy. So the first slide is Aries. This is the main slide. This will tell you what the performance is over 3 months, 12 months, 24 months. It'll tell you what the rules are for Aries. It will also give you some basic drawdown since inception that are worse than 10 days, or 10% and worse than 15%, how many days you were in that drawdown, just as an overview. And then it'll give you the beta and the CalMAR/MAR ratio. Show that here as well, just so you have an overview of what's going on, and you'll get the trailing 5-year performance. So it's pretty simple. It shows you from the last 5 years rolling what what Aries versus the S&P or SPX looks like. Then obviously on the second page, we have the since inception performance. It's a little harder to read on this graph, but that's okay. This is just meant to give you some context with a drawdown chart showing you the difference between SPX and Aries drawdowns. And below that, you have all the stats for all of these different breakdowns for the strategy. Now, I want to note, we run Aries with 3 times leverage. That's why we have it here. X3 means 3 times leverage, and it's displayed down here with 3 times leverage. Now, the 3 times leverage portfolio is of obviously up to anyone, or however anyone wants to execute, or even I shouldn't say it that way. The 3 times leverage option is an indicator of how this could be perceived if you were to try and amplify the returns with the given current regular Aries, right? So Aries by itself is always going to be unleveraged. Whenever you see Aries, it's unleveraged. If there's leverage, it's going to be noted in next to it in the multiple with a multiplier within brackets. It'll tell you what the leverage is and by how much. So as you can see here, these stats are all laid out here. And then below this, starting next week, you will see the economic summary for the Eurozone, which will be right below here. But I think that's where we can leave off. Actually, you know what? No, I wanted to talk about some of the objectives behind the QuantDeck going forward, right? So I want to talk about our goal here with what we're going to call the Radar Quant Fund, which is the RQF. And the RQF aims to combine our other strategies, which have yet to make it to the QuantDeck, which are pretty much being fine-tuned right now, almost ready for release. But the RQF aims to combine all of those strategies into one single portfolio, meaning an allocation to Aries, an allocation to Astris, and an allocation to Hercules. Now, all those allocations will be proportional to the underlying portfolio. So you will, if they're not active, you will be sitting in cash for that value. So, example,
Well,
20% of
maybe let's rephrase that. They won't be doing anything because we're not financial advisors, but that's what we're going to be doing. So
right.
we have our crypto fund, and then we'll have our crypto portfolio, and then we'll have our short vol portfolio. That's what we have. Those two are in the works right now. We're trying to optimize those, and then Aries, of course, the bread and butter, which is going to be the dominant factor in the Radar Quant Fund.
Right. And the idea is to basically put together a fund that is executable on a higher level without a lot of stress. You know, it's a fund that by itself is the models are inherently hedging each other. So there's not going to be a lot of work going out in hedging the actual model, right? The model itself would be hedged to get with the other models running against each other, which would offset some of the max drawdowns, offset some of the overall volatility, and therefore stabilize the returns hopefully over the long term. We intend to have the inception date of the fund to be December of 2016. That's where we'll show the returns from. And then we will start tracking that at some point in the near future live in the RP, which is posted daily, which is the Radar portfolio, which is a live account that's posted daily in the members Discord. And again, I do want to clarify, this is what the model that we are using. It's not what you should be using. There's no way that we could know what allocations of any security would be suitable for you because we are not you and we're not investment advisors. So again, this is just what we're doing with our money. And if you follow this, it's not intended to be advice on what you should be doing, but more of just a educational tool on what could be done in the market with these models.
Yeah, but we're super excited to unveil everything. This report's only going to get more in depth as we add more countries to it, add more of our funds to it, and Market Radar is just going to keep getting bigger and bigger, and we will be raising the prices as time goes on. As we get bigger, prices will constantly be rising, but not for current members. So keep that in mind. If you are thinking of buying the membership, the sooner the better, because prices are just going to keep going up. We have some people locked in at $10 a month. And they are super happy with the product that they're getting because we just keep throwing new things out and keep providing as much value as we possibly can.
Yeah, so grandfathering at Market Radar is a thing. All the subs are grandfathered in at the price they subscribe. It wouldn't be fair to raise the prices on someone if they. The way we look at it is we're very down to earth, right? So we're not here trying to make a lot of money selling reports. It's not our goal. Our goal is to make money in the stock market, right? So if you believe in us and you believe in what we're doing and you become a member, that rate is locked in as long as you stay a member. No matter what we do with the price, if we raise the price to $1,000 a month, again, you're locked in. And that's our thank you to you for believing in us and for riding along with us and for being part of the community. So we think that's a great deal for you guys. It's a great deal for us. We get to build a community. You guys get to take part in a higher level and very informative process that other companies would charge hundreds, if not thousands of dollars a year for. So I think that this is kind of like a middle ground, and we hope to keep on making our product better, more robust, and obviously building the community. So if you guys like this video, if you guys like what we're doing, please share this, send this to your friends, send this to people that you know that are in the stock market. And other than that, we thank you so much for your time, and we hope to be speaking to you guys again next week. Thank you so much and have a great start to your week.